In this video, let's break down the impact of active, passive, and hybrid investing using some numbers to understand how they influence returns and risk-adjusted performance. So in the first scenario, we look at a fully passive portfolio. A 100% passive portfolio invested in the Nifty 50 TRI has delivered an average annual return of 13.5% over the past 10 years. Since passive investing simply mirrors the index, its standard deviation, which is a risk measure, has historically ranged between 16 to 18%, making it relatively stable. And the Sharpe ratio, which measures risk-adjusted returns, has averaged 0.75, indicating solid performance with moderate risk. The outcome of this being lower cost, predictable returns, and low risk compared to active strategies, but no chance to outperform the market. Scenario 2, we look at a fully active portfolio. An actively managed equity fund in India, say a large cap category, has historically delivered returns between 12 to 14% annually, depending on the fund selection and management skill. However, the costs are higher, expense ratios are between 1.5 to 2%, and volatility is much greater. And over the past decade, less than 50% of large cap active funds in India have outperformed the Nifty 50 TRI, meaning that active selection carries the risk of underperformance. The Sharpe ratio for active funds typically ranges between 0.6 to 0.8, indicating similar or slightly higher risk-adjusted returns compared to passive funds, with greater unpredictability, of course. The outcome being the potential for higher returns than passive funds, but higher costs and greater risk make fund selection very crucial. The most important scenario being the core satellite portfolio, which is the hybrid approach. Now, let's say 70% is in passive, which is index, and 30% active strategies can optimize performance. 70% in the Nifty 50 TRI ETF with 13.5% return, 16% volatility, and 0.75 Sharpe ratio, and 30% in actively managed mid-cap funds. Now, by blending the passive stability with active growth potential, the expected portfolio return improves to 14.5 to 15% with slightly higher risk than a fully passive approach, but lower than a fully active portfolio. And the Sharpe ratio remains around 0.72 to 0.78. The outcome of this is that we get the best of both worlds, lower costs than a fully active strategy, yet with better return potential than pure passive strategy. So if you want to lower your costs and get steady returns, you go fully passive. But if you believe in fund manager skill and can tolerate higher risk, active investing could work, but choosing the right fund is crucial. But to seek a balance between these aspects, the hybrid approach is what makes it count. It delivers a well-rounded, risk-adjusted portfolio for today's volatile markets. So it's not just about investing in passive funds for getting a kick out of it, but it's also about investing in the right active funds which are well managed in order to get the best results.